Welcome back to Investing Talk Podcast. Today we're zeroing in on a question that's likely on many of your minds. Is Baker Hughes Co. a good time to buy now? We've sifted through a wealth of articles, research, and our own notes to pull out the most vital information, giving you a shortcut to being well-informed.
Yeah. Our mission today is really to cut through the noise and deliver the surprising facts and crucial insights you need about this energy giant.
Exactly. And if you're finding our discussions helpful, remember to subscribe, like this episode, and leave a comment with your thoughts. It really helps us bring these insights to you. And if there's a specific company you'd like us to look into next, just drop a comment below. You can also consider buying us a coffee. Your support is what keeps this knowledge flowing.
So we're going to examine Baker Hughes Co. from, well, every critical angle. Think of it as peeling back the layers. We'll explore its financial health, how the market values it, its strategic position in a shifting energy landscape, and what the future might truly hold.
Right. We want to present a clear picture so you can form your own informed perspective.
Is this a strategic powerhouse pivoting for the future, or maybe still too tethered to the old energy economy? Let's find out. Okay, let's unpack the fundamentals first, starting with their recent performance. Baker Hughes Co. reported quite impressive trailing 12-month, or TTM, meaning the last 4 quarters combined revenue of $27.61 billion. Net income, $3.05 billion.
Which translates to an earnings per share EPS of around, $3.06 to $3.09, somewhere in that range.
Exactly. And here's where it gets really interesting. Their most recent quarterly EPS of $0.63 actually exceeded analyst expectations. The next quarter is estimated at 62 cents. Now, that sounds like a clear win, right? But then we see that revenue has reportedly decreased by 3.2% year over year. So how do we, reconcile an earnings beat with a dip in top-line growth? Well, that balance between the EPS beat and the revenue decrease is actually quite telling. It suggests Baker Hughes isn't just treading water. They're demonstrating significant operational agility. Exceeding EPS expectations when revenue is falling means they're exceptionally good at managing costs and increasing efficiency.
So pulling more profit out even when sales are down.
Precisely. Extracting more profit even when the overall demand or pricing environment is challenging. This capability, especially in the highly cyclical energy sector, hints at a lean structure, strong internal controls. It could potentially differentiate them from competitors who might struggle more under similar conditions. It signals a company that's tightening its belt effectively.
Okay. And speaking of financial health, their foundation looks pretty solid, doesn't it? Baker Hughes maintains a moderate debt-to-equity ratio, 33.8%. for its sector.
Which is pretty reasonable in this industry, yeah.
And that's backed by positive cash flow and strong earnings. With a market cap of $44.13 billion, it scores well in risk checks, no sort of red flag risk detected. And for those of you looking for income, there's a consistent dividend payout, $1.92 per share annually, yielding about 2.06%.
Right, with that recent ex-dividend date of August 5, 2025. Stepping back, these financial metrics, they really paint a picture of a financially robust and stable company.
Stable's a good word here.
Yeah, a moderate debt load, strong cash generation, and that reliable dividend payout signal a commitment to shareholder returns and, crucially, a capacity to weather market fluctuations better than maybe some of its peers.
So for you listening, this translates to a company with a strong, resilient foundation.
Right.
It minimizes maybe some financial instability and offers consistent income. That could be appealing in a volatile sector like energy.
Definitely.
Competitively, Baker Hughes Co. stands as a top-tier global provider of energy and industrial services. They've shrewdly diversified their revenue streams through their traditional oil field services and equipment segment and their growing industrial and energy technology segments.
And that's not just a casual diversification, is it? It's a deliberate strategy.
Seems like it. To reduce their dependence on the often volatile swings of crude oil prices. And even with some recent management changes, they remain one of the big 3 oil field service providers globally. That says something about their market position.
It does. And a key question emerges here. How does a company like Baker Hughes truly remain competitive in such a rapidly evolving energy landscape? Their strategic diversification into distributed power and new energy isn't just about managing current oil and gas demands.
It's looking ahead.
Exactly. It's a forward-thinking move to position themselves for the broader energy transition. This shows foresight, adaptability, things that are absolutely vital for long-term success. The management changes, in this context, could even be seen as a proactive effort to refresh leadership and really drive the strategic pivot.
Interesting perspective, making sure they can innovate beyond just traditional fossil fuels.
Right.
Now let's talk about what the market actually thinks Baker Hughes is worth. Valuation time. Looking at valuation, it trades at a trailing price-to-earnings ratio, PE, of 14.61. Forward PE is 18.22. Their price-to-sales ratio is around 1.6. Compared to broader industrial averages, the PE seems competitive.
Yeah, it suggests it's neither like a screaming bargain nor significantly overvalued.
Right. Analyst consensus points to a fair valuation. Average price targets are between $51, $11, and $52.29. That suggests maybe a 12–14% upside if projected growth is met.
But it's worth noting that range is quite wide, isn't it? From a low of $37 to a maximum of $60.
That's a big spread.
It is, and that modestly undervalued assessment is interesting. But yeah, we should dig a little deeper. It implies that while it's not a deep discount, there's still potential for appreciation if the company hits its growth targets.
Okay.
So for you, this means it's not priced for perfection, leaving some room for upside. However, the market has largely priced in current expectations. And that wide range in price targets, the $37 to $60, tells us there's a moderate risk-reward skew.
Meaning different analysts see things quite differently.
Exactly. Varied perspectives on future performance, the success of their diversification, and, inherent sector risks. It's not a unanimous conviction, which is important to remember.
Got it. Moving to the technical side then, the current price for Baker Hughes is $44.76. Its 52-week range has spanned from $32.25 to $49.40. We're currently seeing support forming around the low $40 maybe, with resistance near $48.50.
Seems about right. And looking at momentum, the price is holding above both its 50-day and 200-day simple moving averages.
Which generally signals what? A healthy trend.
Yeah, perhaps slightly bullish or at least not a sustained downtrend. It's generally positive. The 14-day relative strength index, the RSI, is sitting at 46.74.
Pretty neutral territory.
Very neutral. No immediate signals of the stock being overbought or oversold. Suggests a balanced sentiment right now.
And volatility.
Moderate, around 5%. And with a beta of 0.92, it's actually less volatile than the broader market.
Okay, so these technical indicators seem to back up that idea of stability we saw in the fundamentals.
They do. The price consistently staying above key moving averages is a positive sign for short to medium-term trends. And the moderate volatility and that lower beta mean that, for you, the stock tends to have smoother price movements compared to the overall market.
Less drama.
Less drama, exactly. While it might mean it doesn't capture the full exuberance of strong bull markets, it also offers a somewhat calmer ride during downturns, which can be quite appealing.
Sure. And the neutral RSI just reinforces this balanced trading environment for now. All right, let's turn to recent developments in market sentiment. Baker Hughes Co. has experienced some management changes recently, which, can sometimes create uncertainty.
Always something to watch.
But a powerful counterpoint is their consistent track record of beating recent EPS expectations. That reinforces their operational momentum and ability to execute.
That's a strong signal, yeah. Suggests the engine's running well despite any leadership shifts.
And analyst sentiment. Overwhelmingly bullish, 20 to 26 of them rating it a strong buy or buy.
Projecting what, 10–16% upside over the next 12 months?
Yep. Insider ownership is quite low, 0.27%, but maybe that's not unusual for a company this size.
It's not terribly unusual for a large cap industrial company, no. Executive compensation often includes various forms of equity, not always direct stock purchases, but the market interpretation of these signals is key. While management turnover can introduce uncertainty, those consistent earnings beats really mitigate that concern.
Suggests the company's operational engine is running well, regardless.
Exactly. And the overwhelming bullish sentiment from analysts with those significant upside projections, that's a powerful endorsement. It shows confidence in their future.
So for you listening, it indicates a strong professional consensus that the company's on a positive trajectory.
And as for a low insider ownership, well, it's not a red flag. It just means management's financial incentives might be less directly tied to the daily share price compared to companies with higher insider stakes. It's just a factor to note.
Okay. Looking at upcoming catalysts then. Short term, the next earnings report on July 22, 2025 seems crucial.
Definitely. Any significant surprises there, positive or negative, could trigger a substantial price movement.
In longer term.
The growth levers lie firmly in those new energy and distributed power segments. Their ability to scale these will be a defining factor.
We also need to keep a close eye on possible M&A in the sector, regulatory shifts, and just broader macroeconomic trends.
Absolutely. Global energy prices, industrial spending, these external factors will undeniably be crucial drivers for the company's performance. So, what will truly define Baker Hughes Co.'s future, particularly for your long-term outlook? While short-term earnings are always a factor, the enduring narrative hinges on their successful execution and expansion in new energy and their ability to adapt to evolving industrial demands.
It's not just about today's oil prices, then.
Not at all. It's about their strategic positioning for decades to come, especially as the broader energy industry continues its pivot towards renewables integration. How well they navigate these transitions, that's the ultimate determinant.
Of course, every investment comes with risks. Let's touch on those. On the stock-specific side for Baker Hughes, that recent revenue contraction is definitely a concern, right?
It is. It highlights potential demand or pricing headwinds that even an efficient company might struggle to overcome if market conditions worsen.
And the low insider ownership, while common, could be interpreted by some as maybe a lack of strong personal conviction from executives.
It's a possible interpretation, yes. And, as we mentioned, any management turnover always introduces some execution risk. A new team needs time to fully gel and implement its vision without hiccups.
Right. These stock-specific risks are important for you to consider. The revenue contraction, for example, could indicate that even a highly efficient company like Baker Hughes faces macro challenges impacting its top line.
Makes sustained growth harder, potentially. And while low insider ownership isn't a direct warning, it just means management's incentives might be structured differently than at companies where executives hold larger personal stakes.
And leadership changes always mean a period of adjustment.
Always some potential for strategy or execution to waver slightly during that time.
Then we have the broader market and sector risks. The energy sector is just inherently exposed to commodity price cycles.
Highly exposed. And regulatory shifts, geopolitical events. It's a volatile mix.
So a general economic slowdown or drastic drops in oil demand or prices could materially affect Baker Hughes's results, regardless of how well they manage things internally.
Yeah, and it's clear how these broader risks really underscore the critical importance of Baker Hughes's strategic diversification.
Bringing it back to that.
Exactly. While they are undoubtedly exposed to the cyclical nature of the energy sector, their industrial and energy technology segment and that proactive push into new energy solutions are specifically designed to mitigate some of these external shocks.
So for you, it's about understanding that even a well-managed company in this sector will always face external headwinds.
Right, and diversification acts as that crucial safeguard, offering some stability in an inherently unpredictable industry.
Okay, so let's try to sum it all up for you. Baker Hughes Company receives an overall rating from our analysis of 7.5 out of 10. It really combines strong financial health with stable cash flow and dividends, a competitive market position as one of the big three, and strong analyst support pointing to modest upside.
And the technical picture generally supports a neutral to bullish outlook, offering, like we said, above-average stability for its sector.
So, considering your investment horizon, who does this suit best?
Well, Baker Hughes appears best suited for long-term investors, I'd say. Its stable dividends, robust financial health, and that exposure to long-term energy transition trends offer a compelling narrative for patient capital.
And for short-term trading.
The upside seems moderate, around 10–15%, with technical support favoring a bullish lean. But significant gains in the near term would likely depend on upcoming earnings really exceeding expectations, or perhaps major sector news catalyzing bigger moves.
It's definitely a complex picture with a lot of moving parts. So here's a thought for you to chew on. How do you weigh the inherent stability and dividend appeal of a legacy energy player like Baker Hughes against the transformative potential and perhaps higher growth opportunities, but also risks of its emerging new energy segments?
That's the core question, isn't it? As the global energy landscape evolves, where do you see the next decade of energy investing truly taking shape?
Something to think about. Thank you for joining us for this look at Baker Hughes Co. We hope this discussion has provided you with valuable insights. Make sure to subscribe, like, and comment to stay informed. Until next time, happy investing.